Hey everyone, Rob B here with Rob D. And in this week's episode, we want to make you experts because we've been on a mission to up your knowledge for over 400 episodes now. And something we really want to help you understand is, what are property funds and should you be ruling them in or out? We give the case for both. And you know what? Your worst case scenario from this episode is that you're going to learn a lot, but it may also help you make better investment decisions as well.
Welcome to the Property Podcast, where every Thursday morning, property investors come to be informed and inspired. Property funds are, like Rob said, the main item on the agenda this week, as well as a very interesting news story. And make sure you stick around to the end for extra, because we've got an extra resource for you as well.
Okay, so it's time for our news story of the week. And in the market update last week, we covered rents quite a bit, but another news story has emerged, this time from the FT. And it's really interesting because it's talking about the London rental market. We've talked about Manchester and Leeds and other areas recently, but London, what's happening there? Because it really suffered over the pandemic. The FT brings us an update, Rob.
Yeah, the headline is Return of the Renters, Price Hikes, Bidding Wars and Bribes. The piece is actually very good, but that headline sums it up. You don't really need to read it because that is apparently what's happening. The rental market in London is bouncing back so strongly that it's like the last couple of years never happened. So when COVID kicked off, the London rental market really, really suffered. If you were a renter in 2020, in the first half of 2021, you could have gone and got yourself an incredible deal. There were some rentals being advertised at 40% less than they had been previously. So there were some huge savings on offer for renters because landlords were just really desperate and there weren't that many people around. There was new supply. It's a kind of trend that we've covered extensively over past market updates on this podcast. But now, as people are returning to the office, and there are stats in here about how the number of bus and tube journeys are back up and not back at their peak yet, but are getting close to it, rental demand in London is exploding. So not only are rents picking up, but people are struggling to get viewings at all, and properties are going under offer on the same day that they're listed and things like that. So I wanted to cover this story, Rob, for a couple of reasons. One being that it's nice to have a good news story about London because they've been in short supply, not only because of COVID, but before that when prices in London were performing poorly compared to most of the rest of the country, but also because I'm sure this is not just a London phenomenon. If you're looking at the drivers of this, the same is going to go for big cities like Manchester as well. And this very much backs up something that we've been saying on the podcast in recent months, which is that the death of the city centre has been called somewhat prematurely.
Absolutely, Rob. That's kind of the unofficial third reason, is proving us right. But in particular, proving you right, because I remember you went very early on saying, do not write off the city centres. I think this will bounce back. And while at the time I agreed, I think you saw it bouncing back even quicker than I did. And I must admit, I am surprised that it's happened this quickly. Fully expected it to happen, absolutely. But actually, while this story probably isn't going to get a lot of people's attention outside of the property world, I think it's important for us to put it in front of everyone this week in the podcast, because this is a big news story. Like the death of the city centre, people probably think it's still dead, but it's not. It's booming. And like you said, Rob, Manchester and Leeds, absolutely the same. Other markets as well. We've got exposure to these markets. We're seeing it play out. Not only are properties renting quick, but rental prices are going up because of that, because of the supply and demand issues. So while it's a nice news story, I think it's a big news story. And it's one that allows you as property investors to be ahead of the curve, because this isn't a mass opinion yet. People don't believe in the city centres yet, and it might take some time. So for you to be ahead of the curve, it allows you to make better investment decisions, whatever they may be. If you've invested in cities before, then you may feel comfortable going in again. If it's something you were considering before the pandemic, but have kind of been cautious since, well, maybe it gives you more confidence. And even if you were going to go as far as to start to liquidate your portfolio in city centres, maybe that's a little premature. Maybe sit and watch for a bit longer and see what's happening, because there are certainly green shoots plus a little bit more, which means that our optimism around city centres only continues. And I think it's going to be interesting to watch what happens over the coming months as well, to see how far this trend goes.
Let's move on to our main topic this week, which is property funds. Something we've talked about on the podcast a couple of times over the last 450 odd episodes, but not all that often. And now is a timely moment to talk about it again, because as you've probably heard over the last couple of weeks, we are launching something called Portfolio, which we are exceptionally excited about. The Property Hub community is also exceptionally excited about it. The response has been unbelievable. If you don't know what Portfolio is, then go over to portfolio.co.uk to get yourself on the waiting list for when we open up. But Portfolio is built on top of a property fund, and as a result, funds are something that we've got to know extremely well over the last couple of years, but it's something that not many property investors have much knowledge of. So in this episode, we're not going to be talking about Portfolio, we're not going to be talking about our fund, but we're going to talk about property funds in general, because they're absolutely not going to be right for everyone, but they are an option that could be very appealing for certain types of investors. So it's well worth filling in that knowledge gap.
And even if you have zero intention of ever investing in a fund, you still, as an investor, need to understand what it is. Because why would you want to be blind to something that's operating in your sector? So let's start with the basics. What is a property fund? Well, it's a way of buying a small piece of a large portfolio that someone else manages. So think of the fund as a wrapper around the property portfolio. The property fund performs just like a normal property. It's rented out for income, and it can go up or down in value as well. So the financial performance, the way it rewards or doesn't reward you, is exactly the same. So if you buy 1% of the shares in a fund, you're entitled of 1% of all the rental profits after cost. And your share will rise or fall in value based on the value of the property and the performance of the fund.
Yeah, so while a fund might sound like a scary, hard to understand thing, I think what you said earlier, Rob, is the best way of thinking about it. It is a wrapper around a property portfolio. So it's still the property asset that's important. We'll talk more later about what funds you invest in. So this is quite a shift, because normally when you invest in buy-to-let, for example, you'll go and choose the property that you invest in. And then if you buy another one, you go and choose that. With a fund, you don't. You get exposure to everything that's within the fund, and then if the fund goes and buys more property while you're still invested in it, then you get exposure to that as well. But you haven't made the choice about which individual properties get bought. You do, of course, though, get to choose the fund that you invest in, which means that you can look at the type of that property that that fund owns. You can look at the management of it and see if you're aligned with their ideas about what the fund should be investing in, and effectively be making your investment decisions at a higher level. And that leads nicely into the benefits of investing in a property fund. We'll talk about the drawbacks as well, but let's start with the benefits. And the first one is diversification. So as we just said, you get exposure to a little piece of the performance of everything that's within the fund. And depending on the size of that fund, that could be hundreds or thousands of properties. If you're investing on your own, you're probably not going to get up to hundreds or thousands of properties. Sorry to break it to you. You might, but it's more likely to be just a handful. So by investing through a fund, your money is diversified across probably a larger selection of assets, which would mean that if you've got one or two properties that are empty or having issues, that has less of an impact on the overall performance than it would do if you only owned 3 properties, for example.
Another reason why you might invest in a fund is because you can invest in things that you'd never be able to invest in by yourself. So you wouldn't go out and go, you know what, today I fancy buying a shopping centre. Or, I'm going to own a warehouse that Amazon uses. Or I fancy that block of 100 apartments. It's just not going to happen. And maybe you aspire to own those type of investments. And a way of doing that is through a fund, because some funds will go and buy those type of investments. As Rob said, you have different funds for different investment strategies. So they're unlikely to do all of those in one fund. But you'll have funds that specialise in warehouses, you'll have funds that specialise in residential property, and you'll have funds that specialise in shopping centres. And you have others that have a bit of a mix. So you can go and pick which one suits you, and then you can have exposure to those trophy assets. Another big one, and this one's really going to appeal to a lot of investors who've had to go through the process of getting a mortgage, is you don't have to arrange mortgages, because the fund may choose to use leverage. But if it does, it's no hassle on your part. They have to sort it out for you. And if the fund decides to use leverage, then you'll benefit from all the lovely things that leverage brings you, and also the risks as well. But the wonderful thing is, you don't have the headaches of going through it and finding out at the last minute whether you've got a mortgage or not, or whether the surveyor doesn't like something about it, or you've not realised that a particular lender won't actually lend on the property that you've applied for a mortgage on, and you've wasted weeks and weeks and weeks, and your purchase will fall through. Yes, some of the things I'm saying now are probably resonating with a lot of investors. So the fact that you don't have to apply for a mortgage by investing through a fund is very attractive. And Rob, probably one of the more obvious ones, but it's worth saying because it leads on from what I've just said already about mortgages, but there is no hassle with a fund. It's 100% hands off.
Exactly. It's as hands off as you can possibly get by investing in property. You do not have to do anything. Not only that, you can't do anything. Unless you own a gigantic percentage of the fund, they probably wouldn't take too kindly to you turning up and trying to have a say in what happens. There are other relatively hands-off ways of investing in property, but using a fund is 100% hands-off. So for some people, that is going to sound very appealing because there are other relatively hands-off ways of investing in property. So if you imagine a spectrum, which up one end has got doing a flip and being hands-on, doing all the work yourself, then down the other end of the spectrum, you've got a buy-to-let property where an agent looks after it for you. Well, then imagine even further down that spectrum, an area that you possibly haven't even thought of before, where it's completely hands-off. There is nothing to do. So if you're someone who wants exposure to property, you understand it, you're excited by it, you get it, but you just do not have the time to do any of it yourself, or you've got things that you'd rather be doing with your time, then this can be a very attractive option. It can also be a drawback, and we'll come to that later on as well. But the final advantage of investing through a property fund is the lower entry point. You don't need as much cash to get involved.
No, you don't. So some funds may be as low as £100 to get involved, whereas buy-to-let, really, you're looking at around 30,000 to get started. So you might be on your way to saving for that 30,000, but are feeling like you're missing out and want exposure to property. A fund can be a way of bridging that gap. Even if you want to be really hands-on with your portfolio at some point in the future, if you want exposure to the property market while you're building those funds up, then a property fund may be attractive to you. Or if you just don't want to put all that money in, maybe you go, you know what, I like property, I really like what it can do, but I want to mix it up. I only want to put 10 grand into property, and I only want to put 10 grand in shares, and I want to put 10 grand in gold, and I want to put 10 grand in Bitcoin. Well, by using a fund, that's a way you could implement that strategy. That said, there are people who put large sums in because they want all the exposure, but they don't want the hassle like Rob's talked about previously. But of course, there are downsides as well. It's not all up to any investment strategy. Of course, there are counter arguments, and we've got some to run through with you. Now, Rob's touched on this already, but you don't have control when you invest in a fund. So yes, you can pick the fund, and yes, you research it and go, okay, I like the type of property it invests in, I like the areas it's exposed to, but you can't then go in and go, I'd actually like this wall to be painted blue, please. The people who run the fund will be like, no, that's not going to happen. Some investors love to be really hands-on. They want to know their tenants. They want to pick the furnishings. They want to pick the property within the block or the street that it sits on. And you know what? That's great. But if you want that, a property fund might not be for you. Another thing is there's an extra layer of costs that have to be accounted for before profits are paid out, because the fund itself costs money to run. So you need to look at those numbers as well and make sure you're happy with that. Now, Rob, we're talking about funds in general here, but there are different types of funds. And I think it's worth pointing that out because a potential downside is that you might not be able to get out of a fund when you want to. So normally funds are seen as quite attractive because you can get in and out a lot quicker than a property. If you want to realise some cash from a property you own, you have to go and find an estate agent, you have to get it listed, you have to arrange the viewings, then you go through the negotiation and then you sell. And hopefully during that process it doesn't fall over and you don't have to start it again. Hopefully it goes all smoothly. And then after a few months, you'll eventually get the cash owed to you in the bank. Now with a fund, it can be a lot quicker than that. It can be days or weeks before you get your funds. But it's not guaranteed. There are different types of funds and some allow you to get in and out a lot quicker and some aren't as flexible. But there are some things that you need to be aware of because they might not always be as liquid as you'd like them to be.
Yeah, I think a really important thing to keep in mind is that, remember what we said about the fund being a wrapper around property. The property is still relatively illiquid. Nothing magically changes just because you put a fund around it. So you're still in a situation where you have these big lumpy assets underneath that take time to sell. And there's no perfect solution to that. There are lots of different types of property fund with different terminology, different categorizations. It gets a bit confusing, but there are broadly two classifications that are important when it comes to being able to sell. And that is open-ended versus closed-ended. So if a fund is open-ended, then in theory, you'll always be able to sell your shares. If you want to sell, the fund has to say yes and try to accommodate that request. But that can be a problem because if you're in a situation where the property market isn't doing very well and lots of people all want to sell at the same time, then the fund could end up in a situation where they're forced to sell a load of property at the worst possible time to pay back the people who want to exit, which is actually really bad for the people who are willing to stay in because these assets are having to be sold quickly, which makes it hard to get the best price and at a bad time in the market to be doing that. As a result of that, in practice, these funds that are open-ended end up being what's called gated, which means they say, we know we said that you would be able to get your money out at any time, but actually we're closing that for a bit because of how market conditions are right now. So you may have seen stories in the press a few years ago about commercial property funds where people were unable to get their money out. Those were open-ended funds, or supposed to be open-ended. So people thought that they'd be able to get their money on demand and then were very upset to find that they couldn't. The other type of fund is closed-ended, and that means that there is no guarantee that you're going to be able to sell at any particular time. There's no obligation for the fund to buy your shares back, and so you can only sell if another investor wants to buy your shares from you. So what that means, quite obviously, is that if too many people want to sell at the same time, the price of those shares might need to drop to attract other buyers into the market, or there might not be a buyer at all. So in other words, you might not be able to sell your shares at a price that you're happy with, or you might not be able to sell them at all. So there's no perfect way of cracking this. The underlying property is still illiquid. So while generally it's going to be quicker and easier to sell than it would be if you owned a property yourself, that's not guaranteed and there are drawbacks. Another drawback, Rob, is volatility. The pricing of funds is a bit more exciting than owning a buy-to-let, and that's not necessarily a good thing.
Yeah, because some people may love the idea of seeing their property revalued on a regular basis and therefore their share price at the fund moving frequently. Because depending on the type of fund you invest in, the movement could be every second. Now, it might not be moving ridiculously volatile, but it could be moving up or down. And some funds are done monthly, for example. So not as volatile, so you don't see the price movements as much, but you'll still see them more regularly than you would if you were in the property outright. Now, you might be listening to this and going, wow, well, isn't that a great thing? And for some people, it might be. But for others, they might get nervous by the fact that their properties are moving up and down on a more regular basis. And therefore, it requires a little bit more discipline as an investor because you might be tempted to overtrade. And that's because the values of the property might move up, so therefore the share price might move up. And then you go, right, I'm going to come out now. And then it might move down a bit, but then you might be tempted to sell a bit more. Or you think, okay, I'm going to invest a bit more now. The challenge you have is it's possible that you can overthink it. Now, you shouldn't really be operating that way with a property. We've always said that property, even through a fund, should absolutely be viewed as a long-term investment. And that's absolutely the case. But because you've got the ability to treat it like a short-term investment, it means you might. But when you do it that way, it increases the risks. I think it's also worth saying that through the history of funds, of all the funds that are out at the moment, they're boring. Funds can be a great way to invest. But let's face it, it's not the most thrilling type of investment. You might get a fact sheet every quarter, you might get a little bit of a report that has a couple of pictures in and a lot of text, but it doesn't get the pulses racing and you don't really feel an attachment to your portfolio. Now, obviously, there's a new kid on the block that's looking to change that, but for what's out there at the moment, it's not that exciting. And I know it sounds a little bit crazy, but for all the reasons we've listed, that possibly is the one that puts a lot of people off, is that they don't feel the connection to their portfolio and their investments. And you know what? We should invest with our brain 100%, but none of us do. We all have a heart when it comes to our investments. Even if we don't want to admit it, we do. We are led by our emotions. And you know what? I don't think there's anything wrong with saying that you want to enjoy investing. I'm the same. I want to enjoy my investments. I want them to do really well, first and foremost, but I also want to enjoy the process of investing, whether it's in property or anything else. So sometimes funds fall a bit short here at delivering that. Of course, though, as you know, we're looking to change that. So let's get into who funds are right for. Because as Rob said earlier in the episode, funds aren't for everyone. They are great for some people and they're not great for other people. So we're going to quickly identify who may be attracted to a fund and who is going to be put off by a fund. So, Rob, let's run through that list. Who are funds potentially right for?
Well, the most obvious one is someone who doesn't have the cash to get involved in property by owning it directly, because it means that funds are the only option. As you said earlier, you're looking at really minimum £30,000 to get involved in buy-to-let. If you don't have that level of funds, that's not an option. So if you do want to get exposure to property, then a fund's going to be the only way. Still may not be the right thing to do. It might be best not to do anything at all, but nevertheless, it is an option. You also mentioned earlier that funds could be right for people who are not super into property. They want exposure to other asset classes, but they do want an allocation to property. So say that you have most of your investments in the stock market. That's something you understand. It's something you're comfortable with. That's where you want to be putting your focus. But you understand the attraction of property. You believe it's going to perform well. And so you want a piece of that. But you don't want to have to go through the whole process that you did with shares by becoming an expert, doing all the research and doing everything that you need to do with property, like arranging mortgages, going out and finding the property in the first place, going through the conveyancing process, finding a managing agent, dealing with the things that come up. If you just want to have some exposure to property, but you do not want to do any of those things, then investing in property through a fund could be attractive. We've also mentioned the diversification benefit. So if you've saved up enough that you could buy a property directly, but you're very nervous about having to pick just one property, identify the right one, and then if anything goes wrong with that property, then, well, that affects 100% of your investment. Then the fact that through a fund you could have exposure to far more properties than that could well be attractive. Again, we've already mentioned it's an obvious one that someone who doesn't have a lot of time would find investing in a fund attractive, because property that you hold directly, even if you do it in the most possible hands-off way, it still takes up time. There's still things to do. And indeed, we've got an episode coming up next week about what's involved in a hands-off purchase. And even though it's hands-off, as you'll hear, there's still quite a lot that you have to do. But finally, Rob, I think there's one more point to consider, which I think is really important, because funds are right for someone who has the mentality and the willingness and the desire to give up control. Not everyone does.
Yeah, there's an element of trust involved here. You have to trust the people who are running the fund. And that's where your research comes in. So you've got to do your research. We've talked about that a lot now over the 400 plus episodes we've done. And it doesn't matter what way you're investing in property, whether it's a fund, hands-on, or something else. However you invest, you need to research. So you need to research the type of properties in the fund that we've discussed and the type of properties they want to invest in the future. But then you also need to research the people who are running the fund, and do you have confidence in them? That said, if you go and invest in Disney or Tesla, you have to trust the people who are running those companies as well. Well, you should, and you should research those companies' prospect, and you should research the people that are running those companies. Now, even though that sounds like a sensible thing to do, most people don't do that. Most people invest in stocks based on their gut instinct of how that company will do in the near future. Now, again, I'm going to use that word, emotion, but that's how people often will invest. And people emotionally will just not be able to get their head round a property fund. They may really be receptive to all those benefits, but they just can't get over the fact that they're not going to be in complete control. And that's absolutely fine, because on the other scale of emotion, there's other people who just don't trust themselves. They want to get involved. They want the exposure to property. At least in the beginning, maybe they just want someone else to do it for them. Or maybe just they want it always to be that way. There's no right or wrong here. It's just who you are as an individual. Now, with Portfolio, it's our mission to make people feel as involved as possible. And that's a real motivator for us. But some people may not even feel that what we want to deliver is going far enough. And that's absolutely fine.
So if investing in property through a fund does sound interesting, what should you do? What should you be considering? Well, there are two main points to start with, both of which we've touched on already, but worth recapping. The first is to decide what subset of property you want exposure to. So there might be a fund that invests in family homes, a fund that invests in student accommodation, and a fund that invests in shopping centres. They're all listed as property funds, but they're all completely different. You would not expect the properties within those funds to all perform in the same way at the same time. It comes down to this idea of a wrapper again. It's the property inside the fund is the asset that is rented out, that produces income, that has the potential for capital growth. So the first thing to do is to decide what type of property it is that you want exposure to, and then go and find a fund that owns that type of property. And then the other important thing is to look at the fund manager, look at their performance, look at their credentials. You're not going to be the one making the decisions. They are. So you need to trust them. You need to believe that they know what they're doing and that they're going to make decisions that you would have made yourself had you been in the position to do so. So that's not the end of your research, but that's a good starting point. The property and the people. It sounds basic, and yes, there is a lot more detail, but that is a starting point that you want to make sure that you get right. Now, when you're doing your research, there'll be various metrics available, one of which is the dividend yield, which is just like the yield you get when you own a buy-to-let. It's the income you receive divided by the amount that you've put in. But just like with a buy-to-let, the rental income is only part of the equation. Potential capital growth is important too, and so are many other factors. So it's exactly the same as when you're buying a buy-to-let. The yield is one of the numbers to look at, but it's not the only one. You have to look at the investment in the round, approach it as a long-term investment, take everything into account. So when you're looking at a fund as opposed to a property on Rightmove, you end up getting stats put in front of you rather than having to go away and calculate them for yourself. And that can be a really good thing. But there is a danger that you end up fixating on that. So just like if you're buying a buy-to-let, you need to look at the full picture.
So let's bring this to a close. And at this point, you probably have got an emotional reaction. You're probably thinking, either, wow, funds are great, I want to invest in funds, or oh, funds are not for me. Or maybe, it's not quite as extreme as those two emotions, but you're keen on the idea or you're not so keen. And that emotional reaction could be down to a few things. It could be because you're seeing it as a great opportunity because you're time poor and you want more exposure to property, or you haven't even got to start because of your time commitments. It may be that you don't have enough funds right now to go out and do all the things you want to do with property, and this is a great way to get started. But you know what? It's just not for everyone. Well, this episode is not about why everybody should invest in a fund. It's about educating you so you can make better decisions. And I think while we've done, hopefully you'll feel a decent job of expanding your knowledge on what property funds are, it's important that you carry on doing your research, just as you would for any investment strategy, to make sure that, yes, it absolutely is right for you or it isn't. And again, it's no bad thing if you go one way or the other. It's just what's right for you. And research will help you get to that decision point.
Well, to help you with that research, we've put together a YouTube video on this same topic, which is this week's Hub Extra resource. So we're covering the same topic in a slightly different way. It's a bit shorter and snappier. There are visuals in there as well to help you grasp some of the concepts. So if you've listened to this episode, you kind of get it, but I know there's a lot to take in. Then going and watching that video could be the perfect recap. So just go over to YouTube, search for Property Hub, and you'll find our channel there. And make sure you subscribe while you're there, because we've got some good stuff coming up.
And we've got some good stuff coming up next week, because Rob D is going to be taking us through an investment that he's made recently. But not to tell us about how well he's done, although I'm sure he has done very well, but to give you a realistic insight to what it takes to invest in property, taking you through all the stages that are involved, so you're better prepared as an investor. If you've done hundreds of investments, then maybe you're not going to pick up anything up next week. But if you've made a handful, you've only got a handful of experiences. If you've never invested at all, well, next week is absolute gold. For 99% of our listeners, it's going to be a brilliant episode. And even for the 1% who've done hundreds of deals and they've got loads of exposure and know exactly how transactions work, you still get to nosy into what Rob's invested in. So I'm sure there's something there for you as well. So we'll be back next Thursday with that special episode. And of course, we'll be back with Ask Rob and Rob on Tuesday. So until then, take care, have fun. Bye-bye.
Bye-bye.